This is Rick Goodrich, your Chief of Safety and Security for Bernie ISD, and you're listening to The Ascent with Crestmont Private Wealth.
The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
You're listening to The Ascent with Crestmont Private Wealth. This is Alec Walker, EVP of Financial Planning, coming to you from our Houston recording studio. Wanted to take a few minutes today. We're going to talk about a few topics. This will be a little bit of a look under the hood of our investment committee and how we operate from a research, from an analysis, from an implementation perspective under various market circumstances as we're managing portfolios for our clients. Firms like us can have different services. Just as a reminder for those listening, we are a holistic wealth management firm, meaning that we provide financial planning, investment management, insurance planning, estate planning, tax planning as it relates to your financial situation. All of these services are inclusive of our investment management fees. So if you have any questions about how we may be able to serve you, please reach out to us via info@crestmontpw.com. So our investment committee, we meet at minimum on a quarterly basis, and we just recently completed a rebalance of our core globally diversified portfolios. These are about 7 different portfolios ranging in risk from conservative to ultra aggressive, and they consist primarily of low-cost ETFs and some institutional grade mutual funds. What a rebalance means is that if somebody is in our balanced portfolio, and they've got a target stock allocation of 50% that can range up to 55 down to 45%. Once it gets up to that upper range, that generally, and not always, is going to trigger us to say, okay, we need to rebalance. We need to bring it back either to our target or closer to our target range. So we actually started this conversation, I guess this would have been end of March, early April, when we were having our regular quarterly review. And we had a couple of meetings going into this as we were kind of dealing with the conflict going on in the Middle East. A lot of volatility going on. But, when we think about what is our mantra, we were having a great discussion with one of our advisory board members on when you're kind of a decision-making process is, number one, what's your policy? Number two, what's the strategy going to be? And then number three, what are the tactics to implement this? So from our investment committee, as I mentioned, our policy is when our portfolios get out of range, our clients trust us to maintain their accounts within certain ranges based on their risk tolerance, based on their financial goals to kind of manage that risk and return profile. And so our policy as a fiduciary and duty of care as professionals is, occasionally we're going to be required to rebalance to maintain and control that risk. And sometimes, this is not necessarily going to enhance returns. Because if you think about it, selling stocks, reducing risk, if the stock market continues to run, we may be missing out on some upside, but it's about maintaining that risk and maintaining that discipline. So number one, that's our policy. And so when those are triggered, we have to say, okay, we are in a rebalance environment. Now, what is the strategy that we're going to implement to handle this rebalance? So number one, we take a bit of a different approach. We're not on a rigid calendar-based strategy where on every June 10th, we're going to rebalance, Mr. and Mrs. Smith's portfolio because that's their client anniversary. No, we take more of a threshold-based approach. So like I mentioned, we have those ranges on our portfolio asset classes, and we can decide how far to tweak those and the timing of that as well. Number two, the second strategy we kind of implemented is it's a bit more of a tax-aware approach this time around. Obviously, we're going on a 3-year bull market run where the stock market has grown. So obviously, there's going to be some potential tax implications for clients. So we looked at first separated client accounts to say, okay, any taxable investment accounts, we're going to maybe take a little bit of a different approach than we are for our IRA or tax-deferred accounts, because we can take those IRA accounts all the way back to target with no tax consequences since capital gains are deferred within the IRA vehicle. So we kind of separated taxable versus tax deferred accounts. And then kind of putting a bow on, kind of why to rebalance to explain to clients is according to Vanguard research, rebalanced accounts that are rebalanced periodically, systematically, historically experience about a 20% lower volatility. And now, again, that can give up some upside, some return, but we're looking at both the risk and the return approach of our portfolio management. And then, so that's kind of the strategy, kind of where we want to go on the rebalance. And then as we get further detailed into the tactics, so again, policy, strategy, and the tactics, so then, okay, how are we going to tweak our portfolios? Some accounts, some strategies, it was a pretty significant reduction. It could have been about a 5 to 6% reduction in equity exposure as they had drifted further. Some, it may have been smaller. It could have been a 2 to 3% trim. As I mentioned, we were being tax aware. So for some of our accounts that were going to be experiencing a very high tax liability, instead of going all the way back to target, we may have just trimmed back to that upper threshold. So at least it gets back into range. That was one thing we did. The second thing that we did is kind of a ongoing review within our investment committee is fund selection. In one area, we opted to remove a passive fund that we've had for some time and more get a larger exposure to a active ETF in that same asset class, just because of some of the risk return makeup of that, the performance and track record historically. We felt that that was a better position to be in long term for our clients. And then finally, just kind of touching on the tax implications. This is relative and a perspective for all investors to think about, whether they're clients of Crestmont or not. Taxes are a part of investing. We want to be aware of tax implications when we're investing, but we don't want that to be the driving decision maker. Tax drag, meaning the cost of taxes on portfolio performance, is a real thing. And we try to be as low turnover, low tax drag as possible. That's one reason why we encourage our clients that are still working and contributing to their portfolios to add to their portfolios on a regular basis, because that's going to limit the amount of rebalancing that's required. Because as you're adding to the portfolio, you're naturally rebalancing and buying what is under targeted or under allocated. But we try to think of taxes in a few different ways. Number one, look at taxes and the cost of those taxes as a percentage of your portfolio value, as well as a percentage of the total return. So here's just a quick example. Let's assume $1 million taxable investment account. Under this account, we rebalance it and we realize $25,000 in long-term capital gains for a client. Assuming the highest possible long-term capital gains rate of 23.8%, this would result in a actual tax due of about $5,950, so just about $6,000. That represents 0.6% of the total $1 million portfolio value. So that cost to kind of rebalance, minimize gains, is 0.6% of the total portfolio value. Just a few days ago on Friday, the market was down almost 3%. So if you think about how the market can move just within a day and the relative cost of the overall portfolio, it's a great kind of perspective to kind of zoom out a little bit. And then number two, if you just think about how the market has performed over the last 12 months, the S&P 500, let me pull that up real quick, is up. Year to date, we're up 8%. Over the last 12 months, the S&P 500 is up 24%. So if you think of that 0.6% cost on the 24%, 20+% potential return of your portfolio over the last 12 months, that's a very small cost. So again, that's kind of how we approach our policy of rebalance, our rebalance strategy. And then for this particular instance, it changes from time to time. These were the tactics that we implemented when rebalancing the portfolios. The process took a little bit longer this time because of all the extenuating circumstances with what was going on in markets, managing the tax implications appropriately. But we're really confident, really proud of the execution of our clients to get those portfolios back to target. You're listening to the Ascent with Crestmont Private Wealth. I'm Alec Walker, EVP of Financial Planning. We talked a little bit about our recent rebalance, the strategy behind that. I want to touch briefly on kind of the market concentration and some of those moves that were related to our rebalance. So right now, the S&P 500, I've touched on this briefly, over 40% of the S&P 500 is concentrated in the top 10 companies. This was one thing that drove one of our rebalance decisions, is to just get diversified, get more broadly diversified over different geographical assets as well as asset classes. Post-rebalance, our client portfolios are now allocated a little less than 25% into those top 10 companies. So big diversification, and diversification has paid off this year. The S&P 493, so those non-Mag 7 companies, are up 11% year to date compared to the Mag 7, which is up about 3% year to date. Small cap has outperformed the S&P 500 by about 7 to 8% year to date, and international developed markets are also up over 3% above the S&P 500 year to date. So diversification has been working in our favors. We'll see how that is going to play out going forward. The last thing that I wanted to touch on, and I think as the show is airing today, the SpaceX IPO should have just hit on Friday. We've had a lot of questions from clients on this IPO, and I just wanted to touch on a few things that those conversations that we've been having. Number one, our clients have asked, hey, can we participate in this IPO? And we did some work with our compliance department to figure out if this is something that we could do. And just based on our role as a fiduciary and our current kind of compliance model, this is just something that we are not going to be actively participating or facilitating with clients. But I think one thing to be aware of is there's going to be a lot of news on this. There's going to be lots of good news, a lot of fear of missing out on this IPO and what it could be. And there's also going to be a lot of bad news. I've been seeing stuff, clients have been sending me information about potentially the S&P 500 and these major indexes circumventing their rules and allowing SpaceX to quickly enter those indexes, and then investors kind of being subject to quote unquote holding the bag, as these early investors are trying to exit the position and sell their shares at a much higher price to retail investors or institutional investors like our clients. So there's going to be a lot of news, positive and negative. Number one, as of now, the S&P 500 has announced that they're not going to allow this kind of quick entry into the index, which I think is relatively positive. Let's see how this shakes out. And then number two, the projected size of SpaceX, if it were to be included quicker, or if it were to be included a year from now, as of right now, even in the most aggressive projections, if it's purely based on the valuation, it would be projected that SpaceX would be a 2 to 5% allocation of the S&P 500, which would make it a top 5 to 10 sized company. But there's something that maybe some people aren't aware of, is there's something called the float, or the shares that are tradable on the market. Yes, the SpaceX is projected to be a very low float company. There's not going to be a lot of shares that are readily tradable on the market. And the S&P takes that into account when adjusting for the size on how that company would be as a position within the index. If they would adjust to the float, that would mean that SpaceX would be a 0.2% or less allocation in the index. So even if it were to be added at a much quicker rate than expected, it is not projected to be a significant size in the index, which means if you think about our very well diversified portfolios, it would be even much smaller percentage of the portfolio. So anybody that is concerned about having that be a high concentration of your 401k or your ETF, at least at this point, it does not look like that is going to be a major concern. Now, just real quickly, what are the thoughts on its success as an IPO? The valuations right now showing that the price that it's going to be issued at are very high compared to the financial metrics on the balance sheet, the cash flow, the revenue. But as we know, the market, it's a supply and demand. There may be many people out there that are willing to pay a higher price in hopes that they are able to turn these revenues into future profits. So my expectation is we'll see a little bit of a boost in the near term, but time will tell, as they're now going to be subject to quarterly earnings report, quarterly financials, but only time will tell. We'll see how that plays out. You're listening to The Ascent with Crestmont Private Wealth. Alec Walker coming to you live from our Houston office. And good luck to all the San Antonio Spurs fans tonight, as they not sure what happens in Game 4 tonight, but we know that Game 5, regardless, is going to be coming back home to San Antonio. So looking forward to seeing that game on Saturday. Y'all take care.